Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to the show. Today we have with us Mr. Keki Mistry, who's the Vice Chairman and Chief Executive of HDFc Limited. Mr. Mistry, welcome to CNBC TV18. Now, of course, over the years, HDFc Limited in its performance through various rate cycles and various changes in the overall economic scenario has remained quite unfazed in terms of performance. But we are also getting into a new era right now. In the recent times, we are seeing that we're getting into an interest rate hardening scenario, not just in India but globally as well. There is currency war, rupee has depreciated, and we have also got new accounting norms. Ind-AS has just come in. How are you poised in this changing environment?
Well, my sense is that the consistency that foreign currency borrowing we do, but foreign currency borrowing we fully hedge. So whether the rupee is at 70 rupees to a dollar or it's at 65 rupees to a dollar does not make a difference as far as the profit and loss is concerned.
Okay.
In fact, ironically, when it is higher, when the rupee is weaker, when the rate is 70 or 71 or whatever the current rate is 70, we tend to get a higher rupee amount when we borrow money. And since we hedge it, it does not make any difference as far as our profitability is concerned. And the third thing you talked about is Ind-AS accounting. Ind-AS in a sense is positive for us for two reasons. Well, Ind-AS goes by the principle of recoverability. So what is the security that we carry in respect of a loan? What is its chances of recovery? How much we will recover? Discount that to its present value, and if that present value discounted number is higher than the current outstanding, we are not required to make any provisioning. So in that sense, a provisioning requirement reduces, number one, and number two, our income increases because we do not accrue. We are now able to accrue income on loans where in some of those cases where in the past we were not able to accrue income.
Okay.
The other positive of Ind-AS is that, and very rightly so, the deferred tax liability that we were required to create on special reserve, which I've said this, articulated this time and again, was not correct accounting. That ultimately gets settled once and for all, and under Ind-AS accounting we are not required to carry a deferred tax liability on special reserve. So in that sense, Ind-AS is positive. So I would expect the consistency that we had in our results for the last 20, 25, 30 years or more to continue for a long time to come. The only point I would like to make on Ind-AS accounting is that it brings in a certain degree of subjectivity in terms of valuation, which in the long term could be a little risky in the financial sector for certain companies who could, interpret or make wrong assumptions as regards recovery. So that is a bit of a concern, more from a macro angle.
In the last quarter, your NIMs had gone down by 50 basis points, and the stage 3 of the assets, that is weaker assets, that came in as a surprise. What do you have to say about both these?
Well, first of all, NIMs did not contract. NIMs, to my mind, were stable. When you talk of the stage 3 assets, historically HDFC has always had this practice of carrying excess provisioning. So we've always provided much, much more than what the regulations required us to provide. If you strictly interpret the new accounting standards, the Ind-AS standards, we would not be able to carry that provision and we would have to reverse the provision. So we actually started looking at every single loan in the balance sheet, and wherever there was even the slightest degree of some stress where the payment had not come for 30 days or was outstanding for 30 days or things like that, we classified that as loans where we would carry a provision, and we reflected that as 3A. Now, we see subsequently that many of the other companies have not categorized loans. They've just carried a general provisioning or a standard provisioning or a provisioning for abnormal events or something of that. So that is something which we will discuss with the auditors and take a call on how to take this forward.
So those are still standard accounts for the banks as well, not just for you? For other banks
we
do
largely individual loans.
All right. So this is not coming in from the wholesale. To some extent there would be individual,
some extent there would be individual, some extent there would be non-individual.
All right. So there's a lack of clarity.
Of course, they would probably be standard for everybody.
Right.
I have no idea if they are standard for everybody, but they are standard in the sense they are making payment. There's no outstanding on those loans, or outstanding is less than 30 days.
No, because there was lack of clarity on the composition of this stage 3A.
These are not bad loans. These are standard assets. We were carrying an excess provisioning. We wanted to retain that excess provisioning, and the only way we were allowed to retain that excess provisioning was to identify accounts where there was some degree of delays that were perceived or had happened in the past, and we identified those loans as loans where we would carry a provisioning, and that we put those loans under this category 3A.
All right, when we talk about the entire real estate sector, now it has seen many headwinds, GST, demonetization,
Correct.
and still not out of the woods right now. How do you see the overall wholesale side of the business? Does it have really risks for the overall sector? And some of the loan books have really grown very fast for some of the smaller NBFCs. So how do you see as an industry leader this particular area?
No, not really. What RERA has done is it has brought in a lot more discipline.
Right.
I think RERA is now behind us. Most of the developers have now recognized that RERA is part and parcel of the way they are supposed to function. RERA brings in a lot of confidence amongst the home buyer, so I would view it as a very positive measure. And to my mind, most developers have got adjusted to it. Yes, there would be some small developers in some parts of the country who may find the introduction of RERA a little difficult, but these are not typically HDFC customers. Our customers are largely the bigger developers who we, wherever we talk to them, are now fully attuned to the new environment.
When we come to the loan against property, the LAP book, several analysts have also shown huge amount of concern as far as risks are involved there. What's your view on that?
See, we have been very careful with LAP. So therefore, our loan lending and the LAP is about 4% of our total lending. We give a LAP loan the way we give a housing loan. In the sense, we appraise a LAP loan exactly the way we appraise a housing loan, which means we look at the repayment capacity of the individual, the ability of that individual to service the loan, rather than look at property value and say that the property is worth so much and therefore we will lend X% against that property. So we believe that any lending which is not based on a proper appraisal of the repayment capacity of the individual brings with it a lot of risk.
When we talk about the assets which are in the stress side, now you recently said that you are going to open a fund over there as well, and you would look at opportunities in that area. What is it that's attracting you, and how much funds would be deployed there?
See, this is our core competence. We understand the real estate area. We are in a position to identify a number of projects all over the country where there is some degree of stress which has developed. These are not projects where HDFC has dispersed money, but we get to know this in the market because of our presence in the market. Now, with our expertise and with our understanding of the real estate market, what we thought is if we could set up a stressed real estate fund, the way the fund would operate is we would put in some amount of money into the fund ourselves, but the bulk of the money would come from investors.
Right.
It's still in a very preliminary stage. It's still in a very, very early stage. So I can't comment and I won't be able to tell you what the amount that we would deploy is because we don't know.
Are you also going to tie up with any other fund or any partner?
At this moment, we have not taken any decision on whether we should tie up with anyone or we should do it standalone. It's a decision we will take over time. It's still very, very early days. But we believe that the opportunity to acquire these stressed assets in a half-done stage, get a good developer to come and complete the construction, and then give it the HDFC brand under our supervision, and then sell it at the market at a higher price, offers huge opportunities. And that's the reason why we are looking at, but we are getting into it very, very slowly, exploring it at the moment.
Also, Mr. Mistry, REITs have just about come up. There is every likelihood that before the end of this year, there could be a REIT rolled out after so many years of deliberation on that. What is your view on this, and would you also look at any opportunity in this particular area?
At this moment, we've not taken any view on whether we should get into the REIT business at all. But it's something we will explore over time. But currently, we've not taken any view. And actually, REITs have not really, no real big REIT has really started off. It's still in a very, very preliminary stage.
All right, when we talk about the overall funds for HDFC Limited, and it's such a huge machinery that funds are required, growth capital is required at all points. Now, very recently you had done a massive fundraise. A large part of that has gone in rebuying the HDFC
Bank. Correct.
Yes, but you still have about 5,000 odd crore rupees of kitty left, and you have other
about 4,500.
All right, and
but you know that money will be used for a variety of purposes. Firstly, we need to keep putting capital into our various subsidiaries. HDFC Credila, we put in money. HDFC Credila is an education finance business. Then we said we would look at the health insurance business. Currently, there is nothing in sight. There is no company that we are looking at or talking to, but it's something which we have in mind. It would require capital. Whether it's organic or inorganic, it would require capital. So that's the second area of growth. Third is we talked about the stressed real estate business. So whilst it would be a fund structure, some percentage of the money in that fund will have to be put in by us to give confidence to ultimate investors. So all of that will consume capital over a period of time.
Right. As far as your growth capital is concerned, you still have a warrant conversion coming up in a few months. So that will give you additional around 5,000 odd crore rupees.
Some of that conversion has already happened because it happens in a phased manner, but a large part is still left, yes.
So for some time now, you're done with the capital raising, fundraising?
Oh, absolutely. As far as capital is concerned, we are done with it for a while.
All right. Then how is the strategy going to pan out? So you did mention about health insurance and you have seen some assets in that particular space. Do you think there are enough available still in the market for you to have an inorganic growth in that particular area?
I mean, as I said, we are open to anything. We are open to organic growth or inorganic growth. It's not that we necessarily have to grow inorganically. If we can get inorganic growth, then it gives us a head start. But it's not the only way we can start business. We can even start organically. And that is something we are exploring. We keep our eyes and ears open. If an opportunity comes up to acquire something, we'll be very happy to look at it.
So when it comes to the whole deal street, you have been quite active, at least in exploring the options. We had Max, we had Canfin Homes, we had Star Health Insurance, and there are many other assets which are available right now. What's your view when it comes to something like a PNB Housing Finance and other housing finance companies?
We said categorically that we are not interested in PNB. We were not interested in PNB Housing. We've clarified that to the market. See, what we have to understand, this is nothing to do with PNB Housing, so please understand that. That when there is any acquisition that you are looking at, one has to look at a culture fit also.
Right.
I'm not in any way referring to PNB Housing. I'm just making a very generic statement. That lending, the business of lending is a certain set of values, a certain set of ethics, a certain set of culture that you create. And just going and acquiring something because something is available in the market is not the right strategy, because at the end of the day, the fit has to be right. So we keep our eyes and ears open. If an opportunity does come up and we find that the fit is right, we would be happy to look at it.
So another important aspect of deal making, besides the integration issue or integration hurdle that you mentioned, and many other corporate leaders have also voiced the same thing on M&A. But the other bit is also what amount of cash goes in or how dilutive it can get. Is there also that constraint of a cash deal or an equity deal that is playing on your mind?
No, I mean, any deal that you do, it depends on the size of the deal. It depends on so many factors. Yes, there could be a deal where there is part cash. There could be a deal where there is part shares, or it could be all cash. It could be all shares. It depends on the deal. I don't think there's any particular view one way or the other. If it is accretive to the business, then some degree of cash followed by some degree of shares, which also makes sense, because at the end of the day, you're getting a lumpy growth in your balance sheet.
Okay, why
so I mean, it's an open question. It depends on the facts of each case.
Okay, why I asked you is because in Canfin Homes we had seen similar such constraint, and in PNB Housing Finance also what we gather is that several of the strategics had reached out, and now the company is probably open to a cash and share deal. From earlier only cash deal. So does that change the amount of interest
not
that...
Really. Not really. Frankly, not really.
All right. So, Mr. Mistry, when it comes to the other subsidiaries and the businesses that you have created under the umbrella of HDFC Limited, and you've rolled out 2 in terms of listing in the last 1 year. So, you have been quite active in that particular way. So, now what is the next stage of growth and value creation for the shareholders that you're looking at?
See, we've created value over the years in building up these subsidiaries. So today, HDFC's value doesn't come only from the mortgage business.
Right.
It comes by virtue of not just having the mortgage business, but also being a holding company which has equity in the bank, in the life insurance business, the general insurance, the asset management business, and so on. In fact, the unrecognized profit on our listed investments on 30th of June, this is only on listed investments and unrecognized profit, not value, was 1,68,000 crores. And that was at a time when the AMC was not even listed. Now with the AMC listed, that 1,68,000 crores will become a lot higher. So we carry a huge amount of unrecognized profits on our investments. So that is the value that we have created in the market. We have given birth to a number of companies. We have HDFc Asset Management and Life Insurance, which is listed. Bank, of course, was listed many years ago. We now have HDFc Credila, which is an education finance business. I talked briefly about HDFc Credila, saying we infused some capital into that business recently. We have HDFc Ergo, which is a foray into PNC insurance. At some point of time, over the next 3 to 5 years, we would certainly look at listing these companies. But we have to do it at the right time. It's not necessary that we have to do it to this year or next year. But when we believe the time is right in terms of getting sufficient size, then that is a time we would look at listing these businesses. But these are businesses which at some point of time could be listed.
So you talked about HDFc Ergo, and you have made several attempts at looking at other assets also. So is it going to be two general insurance and health insurance separate? Is that the strategy, or all rolled into one?
The ideal strategy would be that HDFC general, subject of course to regulatory requirements being complied with, that HDFC General Insurance sets up a wholly owned subsidiary or carries out the health insurance business as a subsidiary of HDFC General Insurance. That's the ideal strategy that we would like to look at, subject of course to it meeting regulatory.
Right, and what is your view on the growth for Gruh Finance, because that's also growing fast?
Gruh, we hold 60, little less than 60, about 57, 58% of the equity. Gruh has done extremely well in terms of stability. Its return on equity is over 30%. It's been growing at a compounded rate of over 20% a year for probably 20 years or more. It does not require capital in any way because its capital adequacy ratio is still very high. And it's growing at a stable pace. It lends money to a category of people that HDFC does not generally lend to. Their average loan size is much lesser than HDFC. The average loan size is about 7 to 8 lakhs rupees. And they've handled their asset quality extremely well over the years, with their gross non-performing loans being less than 50 odd basis points and fully provided for.
So in terms of strategy, you would rather have small ticket loans being pushed through Gruh Finance and you stay in your average ticket size?
That's right. Something like that. That is probably the strategy.
And do you think also that to beef up Gruh Finance, an inorganic route can also be taken to?
Frankly, we've not considered that. We've not considered any inorganic growth for Gruh, at least at this point of time. We've not considered it.
All right. And when it comes to life insurance business, now that's doing well. In fact, the stock has been performing very well as well. Now, what is the next stage in terms of strategy and growth for that company? And inorganic growth in that also is something to beef it up further? It's
something we are happy to look at. We did look at Max at some point of time a couple of years ago, and then we went for a listing and we said we were not. But yes, we are open to inorganic growth. It's not that inorganic growth is the only way to grow. If you look at our growth numbers have been strong. And this is despite the fact that there has been no inorganic growth that we have done in the life business. We've done some inorganic growth in a general insurance business, where we bought over L&T General Insurance a couple of years ago. But in the life business, we've never had inorganic growth. And despite that, we've had a stable growth. So our profit margins are good. And we would like to consistently keep growing and keep eyes open for any inorganic growth opportunity which exists.
So, Mr. Mistry, is there any chance that a Max Life deal may resurrect anytime?
There's no discussion with them at this point of time. So I don't know, it's a hypothetical question. But there is no discussion with them.
Why I asked you inorganic is that's not the only way to grow, but then an industry where you're one of the leaders, then consolidation is also a theme which is playing out in this industry. So would you play a consolidator at a time like this?
I told you that in any of our businesses we are open to inorganic growth. But there is no inorganic growth discussion that we are having with anyone at this point of time. So there's nothing at this moment, but we are open to it. If the right opportunity comes up, we are happy to look at it.
Let me ask you a question. You have explored the opportunity in various sectors, various pockets of financial services, and you've seen many companies as well. How have been the valuation expectations? What is your thought process as a buyer in, say, housing finance to start with?
Well, we did see in Canfin Homes that we made a bid at a certain price, which we believed was the right price, and they found that the price that had been bid was lower. They wanted a higher price, and therefore we did not go further. So at the right price, and that price will vary from business to business, an acquisition makes sense, provided the culture fit is there, provided the value systems are in place, and so on and so forth. But at any price which is higher than what we believe is a fair price, we are not interested.
Even in health insurance as well, you did look at Star Health. Now
Correct.
it's gone at 6,500 crore rupees. Having been in the insurance space now for a while, how do you measure the valuation expectations, these valuations?
Well, it's not for me to comment on why the Star Health valuation is 6,500 crores, but our valuation was lower and we put in a value at that price.
So how is the succession planning shaping up with so much depth and talent in your company?
Well, people have been around. There's no there's no imminent succession that we are sort of looking at. But succession is something we always have in mind, and we have an inherent pool of talent of people who can fit into various roles. So I don't think succession, to my mind, is an issue anywhere.
A final merger of HDFC Bank and HDFC, is that at all on the anvil?
Frankly, no, not at the moment. It's something, to my mind, which makes sense. I've said this time and again, but there are regulatory costs associated with a merger, which makes the whole process, the way the regulations are today, very costly. The regulatory costs are in the form of a cash reserve ratio, in the form of a SLR requirement, in the form of a higher priority sector requirement, because HDFC itself is not subject to CRR, SLR and priority sector lending, but the bank is. So if HDFC merges into the bank, then on the entire existing balance sheet of HDFC, which is large, we will create the requirement to have a CRR, SLR and priority sector lending. So unless and until there is some regulatory concessions that are provided by the regulator, the process is very costly. So there is no discussion with the bank. We are both listed companies. We recognize the fact that we cannot make arbitrary comments on merger. We have had no discussion on the subject of merger for a very, very long period of time.
Mr. Mistry, my final question to you would be that there is a lot of talk of Amitabh Chaudhary really making it as the CEO of Axis Bank.
That's what I hear from you. I have no idea. I have absolutely no idea.
All right. Thank you so much,
My pleasure. Thank
Mr.
you so
Mistry,
much.
for joining us.
Thank you very much.
Thanks.